Hi, I'm Jenna.
Jennifer, nice to meet you. I'm Eric.
Okay, I think we're ready.
Great. I'm just going to talk while you guys eat, if that's okay.
Yeah.
And in between questions, you guys can have. And so who is it that's going to be watching the video later?
Unexus.
Unexus. Hey, we're doing this all for you. Dr. McFarland did a lot of work to get that up and running, so praise him later. Okay, so my name's Eric. Many of you I remember, but those of you that are brand new, I'm with EIP. Brand new is a relative thing. Apparently it's been 2+ years since I've been on here. I like the new digs.
Thank you.
Those of you that are new, have you ever been in a 401k plan before? Somewhat, no. It's just a savings account. So because there's some that have been in it, some of that haven't been, and some that have been in one but don't really understand it, we're going to start from the beginning anyway. But I know you guys have patients coming in at some point, so you guys cut me off whenever you need. We'll cover the important things. You guys can, of course, dialogue, ask questions as we go. That's fine too. It's just a savings account. It's just that it has to be sponsored by an employer because the money has to come out of your paycheck. The idea is you're going to, rather than having money going into a savings account and then you have to write a check from your checking account out to an investment account of some sort, there's a lot of steps involved. The idea is that it's going to come directly out of your paycheck. I'm a CPA, can't help but talk about taxes a little bit. There's tax incentives to do that rather than getting it put into your checking account first. If you're like the average person, I'm just going off of averages here, you're in about a 25% tax bracket. Some make more than that, some make less than that, but that means for every dollar that you get paid, you don't really take home $1. Take home more like 75 cents. But whatever you decide to put into the plan, we put that dollar in today, not the 75 cents. The idea is that over time is going to get bigger and bigger and bigger and bigger. Between now when I'm working and when I retire, hopefully there's been enough runway that account gets to a much larger size. The IRS says we didn't tax you today, we gave you that break, we're going to eventually want to take our tax dollars out. So most of us, as of last count, about 87% of us, roughly 9 out of 10, when we retire, our tax bracket goes from that 25% level to roughly half, about 12.5%. So just using some simple numbers, here's the accountant side of me coming out a little bit. If I'm in that 25% bracket and over time I put 40, and you're not going to do that in 1 year, I know, but over a long period of time, $40,000 gets put in. That's $10,000 I took home, got taxed on it. I otherwise owe 10 grand to the IRS collectively. That same $40,000, and I'm not, no match, no growth, no nothing, just that same $40,000. I'm now in a 12.5% bracket. I pay back $5,000, and when I say pay back, in the sense that the IRS is ultimately going to collect those funds, it's just that I'm going to be pulling out much later in life than now. That's like borrowing 10 grand from a bank and saying, I don't know when I'm going to borrow, when I'm going to pay you back, I don't know how long I'm going to hold it, I don't want you to charge me any interest. Matter of fact, I want to invest it and make money, hopefully. And then when I finally decide, okay, it's time for me to pay you back, I want to give you back half of what I borrow. It's kind of silly. I work well with analogies. That's supposed to just illustrate kind of that point. And from what I recall in the last couple of times that I came back here and did meetings is Dr. McFarland is really interested in you guys saving. And I have no problem with you interrupting, asking questions, saying things along the way, because I know this is some dialogue that you guys have had before, and this, a lot of times, a lot of cases, is a little bit of repetition. You guys have heard this before, but a lot of the stuff you haven't. And this really doesn't even get into the fact that, as I read from your employee manual, right there as plain as day is the matching schedule. For those of you that have been in a 401k plan before, and for those of you that have not, a matching schedule typically works in, you put in $1 and we'll match some variation or percentage thereof. So you put in, we put in. If you don't put anything in, we don't match you on anything. Conventional wisdom, that's a good thing, free money, 4% raise, whatever your rate is. You guys, I'm going to add another layer of, not even complexity, another layer of benefit. And that is because your plan is referred to as a safe harbor 401k. Which in English just means that there's a guaranteed match and it's at this set formula. In other words, we don't just wait till we get to the end of the year and say, okay, you know what, business really wasn't all that good, patients aren't paying, whatever the case is, we don't have the money to put the contribution in. We've already committed it, which is great, it's super generous. But the way that this formula works is a little bit absurd. I'm going to tell you technically, and I'm going to back up and say it in English. It's dollar for dollar up to 3%. And then 50 cents on the dollar for the next 4th and 5th percent. This is exactly what this little graphic in here says. But in English, what that means is if you put in at least 5% coming directly out of your paycheck, they will match you, Dr. McFarland will match you 4%. In terms of what you're leaving on the table, whether you choose to put in or not put in, of course, that's absolutely your business. But if you put in that 5 and you're getting matched 4, that's an 80% return on your money before you ever even invest it. So, humorously, we've talked a lot about Bitcoin in the last many meetings that I've gone to, just because it's been the topic du jour. And a year ago it was crude oil and WTI, and whatever it ends up being today. I don't have an investment around that can guarantee you an 80% rate of return right off the cuff. So that's, again, super generous of Dr. McFarland to do that, and that ends up being the case, and just keep going and going and going. The next thing about Safe Harbor, which is really cool, is you're 100% vested in it. Vested is just a fancy word to say, if I quit after the contribution's gone in, how much of that money that the company's put in do I get to take with me? Safe Harbor's 100% vested. So there's kind of a pro and a con to everything. The pro is that, yeah, you get this cool idea, the money goes in, it's vested immediately. The con is, don't let that be a deterrent to stay working here. Don't leave because you want to access the money and take it all with you. The idea is that it's supposed to grow and grow and build up in here. There's the whole idea behind having that to begin with.
So if you go to another job and they offer it, right, you can roll it over.
You can roll it over. Yes, great question. And that also, for whatever reason, has been a very commonly discussed topic, and a lot of times that's because people have already worked at other companies and don't know what to do with the funds out there. So you work at, can I say ABC Dental? There's not really an ABC Dental out there, right? Promoting competition in some way. So you worked here before, you had a 401k, and you've got $1,000 in there, whatever amount, because you haven't been there very long, you found the good graces of Russ, and you decided to go work somewhere else. Okay, so you've got $1,000 that have saved up here. You now have a couple of choices with it. You do not have to leave that fund here. The $1,000 or whatever that you have built up at an old company, or the rollover idea that you're talking about, now you work for McFarlane Dental. You have a 401k plan here. So option 1 is I can roll the money directly from this plan over to this plan. Now I have my $1,000 that I originally had over here. By doing that, the IRS does not treat that as taxable, which is why you use the word rollover.
Right.
So because you got that tax break, the money going in, they're not saying, okay, well, you moved it from this plan, so you have to pay tax on it. You don't have to do that at all. Another option is to move it into an individual retirement account. You've heard of IRA. Sometimes people throw that out there. You go to a bank and you see some of the services that they offer, and they say IRA. It's basically like a mini 401k plan. It's just that it's not sponsored by an employer. Each of us could technically set up our own wherever we wanted to. So moving that over, I could say I'm going to put my $1,000 over here in lieu of leaving it over here. I'm generally not the biggest fan of folks leaving their money in an old company's plan. Tomorrow we could be fired from our position as running your 401k plan, and you could move the 401k over to, fill in the blank provider. If you didn't work here anymore, you would literally have no say in that, and you would know about it because you'd be provided a notification, but whether you actually read those things sometimes could complicate things. I would rather you than leave it in here, move it over here, or move it to an IRA. And you absolutely have the flexibility to do that. So don't feel like just because you put the contribution in here, it's stuck forever, hold your peace. No, it's super flexible. Questions about that? If you grasp that concept, how the money goes in, and why it might be important to you, that's usually the biggest hurdle that you have to overcome.
I have more of like a different question.
Go for it.
So, I know that just recently I unfortunately had to take out money from my 401k.
Yeah.
So I'm wondering about the withheld contributions for 6 months. Why and how is that, how does that happen? And
So
why?
when you're in a plan, you're still there, you have to withdraw some funds out of it, and it's called a hardship.
Yeah.
And then somebody like me.
So I only took a little bit out, but they said that now, so for the next every single paycheck that I have, I'm not gonna have a matching from him or anything.
Right.
Until I redo that or whatever.
Yeah.
Why do they cut you off from that if it's our money?
I know, it's terrible. It's the Department of Labor, it's their rules.
Okay.
There's actually legislation before Congress right now where they would void that 6-month wait and say, look, you stopped and you pulled money out.
Yeah,
What they're
it already puts us back into another hardship again,
Exactly.
because it's not giving us contributions.
What they're trying to do is deter people from getting hardship funds.
Okay.
They refer to taking distributions from your account, whether it's a loan or a withdrawal or whatever. They call it leakage, which is terrible that they call it that. But money goes out of the account. The idea is that we're supposed to keep it in there for as long as possible until you take distributions in retirement. So what they're trying to do is find a way to slap you on the wrist by saying, hey, we really want to disincentivize you from doing that,
Okay.
but it's a really silly rule. It messes with payroll. It does all
Yeah.
kind of.
Because it just showed me, I didn't take that off of here.
Oh, okay, yeah, I can take that off, okay.
Now, there's a way to get around it, and it is a little bit complicated. You feel like you're kind of dancing around in circles and mental gymnastics, but technically what you could do is during that 6-month period, just save up as much as you can, and then when you're in that last 6-month period, or how much left is throughout the year, defer a substantially higher dollar amount or percentage to make up for that period
Okay.
and live off of what you had already kind of accumulated or built up. Just don't forget that come January 1st of next year, drop back down to that level that you wanted so
Right.
that you're not.
But I'm not, like, because I did a hardship, I'm not having to pay that money back, correct? It's not
Correct.
like a loan, like a loan one where I'm taking off a ton of it.
Exactly.
Okay,
Now, the reason that they give you the hardship provisions, and they're very rigid, they being the IRS, are very rigid
Yeah.
on what the rules are that says how much you can take out, barring any kind of, major extenuating circumstances like hurricanes and all that. But out of these set provisions, you pull it out, and the best thing that it does is avoids a 10% early withdrawal penalty. That really only affects anybody that's under age 59 and a half.
okay.
So it's better than 10%.
It is, yeah,
But-
okay, thank you.
Yeah, but no, I completely agree with you. There's, so Senator Warren Hatch, he's very, very pro 401ks, retirement plans. He just
Yeah.
announced he's gonna retire, and we're like,
Finish.
get this
Happening,
done.
Yeah, because
Come
I
on.
mean, yeah, because it's like, I have to tell them, it's like, I'm really hard on money right now, I like, you need this money, thank you for giving it to me, and then they're like, oh, but by the way, you're not gonna accumulate any money during that entire
It's so
6 months.
irritating.
And
I
you're like,
completely side with you on that.
and it's like, okay, well, everything that I just took out equals to the whole 6 months of contributions that
Yeah.
I would be.
So retirement plan law started in 1974. It has not substantially changed since then.
Okay, great.
So think back to what 74 was like.
Great.
We were all living a little bit more within our means. It was just a different environment. But
Okay.
the DOL is like, we got that established. Let's just now leave it alone.
Yeah.
We'll get on to more pressing things. But guys, you have to revisit it. It's like getting your oil change. You can't just put it in there one time and you're done. So anyway, we're,
That's
holding
the
our breath.
2018 version of that. I'm very proud to say that.
I love it.
It's
Yeah, you just redid that. That's pretty good.
Brand new. Hot off the press.
Okay, so what are the questions like that? Because I want to make sure I'm addressing things that are important to you.
How else can I tell if that I'm putting my money into the right like
Investments.
investments.
Yeah.
Or let's say stocks. Yeah, to the right investments. How do I
Okay.
know? Like, because I mean, I can look at the charts all day, but a lot of the numbers look a lot alike, and it's like, where am I getting the most out of it?
And let me give you a couple of thoughts on that. So first thing is a fancy word to say how is my account invested? Asset allocation. It's my investment mix. People say I'm in a 70-30 split or a 60-40 mix. Fancy way of saying what percentage of my savings is in stocks, which are ownership in companies, usually big companies, and what percentage is in fixed type investments like CDs, cash, bonds,
Right.
more stable type investments. So if I think of this as just one big pie chart, and I say I'm in a 60-40 mix, 60% is in stocks, and 40% is, I'll say fixed, but what I'm really meaning is bonds. Generally, this number ought to be about equal to your age. That's just a general rule. So as I get older, so I'm not 40 anymore, suddenly I'm 50, now my mix should look more like 50% in stocks, 50% in the fixed, and that line just kind of keeps coming back this way.
Okay.
And then I need to change mine.
Well, it's worked out really well for you, I'm sure, with the way the stock market's been just climbing as fast as it's been over the last 10 years, really.
Yeah, I'll probably have to come visit.
Absolutely, call me. We're getting to now, we're having all these virtual meetings because people are all over the place, so we literally pull up iPads and FaceTime and say, here's what I'm looking at here. And
Terry's like, I think I'll come in.
we will find a way to have us
I'll come
talk.
visit. Nah,
So then, now with that base,
I like one-on-one, sorry.
I'm a face-to-face person.
Yeah. I need pen and
Picture-
paper and
Yeah. Paper, pen, book, not iPad.
scratch paper.
Okay, picture a closed-in tic-tac-toe grid. So when you look at your statements, either online, the hard copies, when you look at your
I
enrollment
get like my
materials.
EIPs.
Yes,
Okay,
perfect.
And I always see that chart at the top, and I'm like,
You see a little logo that has like this blocked off?
Yes.
It's like stair steps, that's us. Put that 2 extra blocks in there, now you've got this. On the statements, you'll see investments, the name of it, a dollar amount, a price, a ticker. One of the things you'll see in there are some words, and it'll say like large value, small blend, mid growth. That's boil it down to this: closed-end tic-tac-toe grid. Value is up here. Value companies, the technical definition would be the stock is priced lower than where we think it really ought to be. It's a good value. The best way I like to think of it is these are the guys that tend to pay dividends. Dividends are, I own a company wants to say thank you for owning my stock. Here's a little money to say thank you. That tends to be more this side of that box.
Okay.
Then we have growth on the other end. That's the easiest. The name suggests it's built all in there. These companies are trying to get big quickly. So rather than paying dividends, when Apple sells new iPhones, they tend to take all that cash, put more emphasis, research, development, whatever, into building more iPhones because they want to make even more money. Classic growth type characteristic. And in the middle, you have blend. It just means it has characteristics of both. So Apple actually is a good example. That would be, they do pay a dividend, but they're also very growth oriented. So you get another little category in the middle. Then on this side, you have large size companies, middle size companies, small size. These are your Microsofts, Apples, Procter & Gamble, GEs, all the way down to companies you've never even heard of, or I'd be pretty amazed if you had. You get more risky as you go this direction. If this is what the you heard of the S&P 500? So it's basically the biggest 500 companies in the United States. Tends to be a good gauge or view or proxy of how the overall economy is performing based on how these 500 companies are doing. So if we look at it from January up until December, you see things like this, and what we're wanting is for here to here to be up. Yeah, that means you made money. If little dips happen from time to time, that's okay. Those are looked at as buying opportunities if we get a little bit technical about it. It's basically things just went on discount. Like this is Christmas sales at the store. You can stock up on a bunch of stuff. It's the same stuff, it just was cheaper.
What if it plateaus in the spot?
That's actually pretty classic value type behavior. So what if, I'm going to use this as an example of, let's say this is a stock price, not the S&P. Let's say the difference between this high and this low is like $12 per share and $13 per share. So we look at that, or don't think of that as a huge difference over a long period of time. Why would anybody want to buy an investment that is more or less plateauing? Generally, that's because they pay a nice dividend. They're saying, thank you for keeping the capital all built into this company. This is almost exactly like what AT&T looks like. So people that pay attention to AT&T stock, they know that they pay almost a 6% dividend. If they're going from here to here and hardly ever changing, why would you want to buy it? A great little dividend. If you're on this side, you're probably seeing something more like this. The downs will probably be more dramatic, but so will the ups. As you go from large size companies to small size companies, don't at all be surprised when you see these. We call this volatility, the frequency of how up and down it goes and how dramatic that swing is from that midpoint. A lot more common to see that on the small size companies rather than the large size. Same true as you go from value to growth. So growth, small cap growth is like Battleship. Small growth are going to be a lot more volatile. So kind of to roundabout answer your question when you look at your statement, how do I know what to invest in? Don't get caught up in looking at your statement and saying, well, this did 40% and this did 20. I'm going to put all my money here.
That's exactly what I do. I'm like, oh. Okay.
If you've been doing it for the last 10 years, go celebrate tonight because you probably did really, really
Because I never have to
well.
do anything again. Okay, great.
But now's a good time to maybe make some adjustments. So
I know, yeah. So,
going back to when I said, let's say you wanted to be 60.
I want all the money. I want as much money as I can get.
I don't wanna
it's
lose.
true. I mean, everybody that's saving is going to want as much as they can get, right?
You're maximizing your
So,
return.
like,
So
let's make it happen.
have you heard of the phraseology, with risk comes reward?
Yes.
So I've got to be willing to take some risk to get some reward. As you think of it in terms of that, like, I'm going to put 60% into stocks, okay? You don't look 40, but I'm going to say you're 40. So what I have to do is put these percentages. Is that insulting?
No,
sorry.
no, it totally was.
I did
She
it.
laughs and I laugh.
I did a presentation today because all the ladies here, I have to blow some smoke at myself here. I was giving a presentation and somebody said, you look like, and they couldn't think of the name, but they said, it's the guy from The Biggest Loser, and somebody got on their phone and held it up. I was like, wow, thank you. My beard and everything, but I don't know, I was so happy. I blushed quite a bit, but I was happy. So if I'm going to say I want 60% of my investments to be in stocks, you look at it like this and you say, well, okay, well maybe I put 15% of that number here, maybe 10% here and 10% there. maybe another 10 here, 5. You kind of get to decide, how do I want to divide this up? All the while knowing that as I focus more down into this area, I'm getting more and more aggressive, more
Right.
risky. If I want my overall, if I think of this like a big giant cloud, if I want my bubble to look more like that, then 10, 10, 10, 10, 10, you're done. Super easy. The idea behind the investments we give you, they're referred to as mutual funds. And for those of you that haven't really been involved in investing all that often, back in 1934, we just came out of the Great Depression, stocks basically just plummeted. So imagine if you owned one stock. And some of you remember the name Enron. So imagine you owned 100% of your money was in Enron, and Enron went out of business. Your money was flat gone. You have a piece of paper that says you can buy Enron stock, but it's not worth anything. So the idea back in 1934 was, why don't we pool all of our money together and hire a firm, in this case a mutual fund, to
Come on.
do all
Hi,
this.
come on in.
Hey, how's it
Welcome.
going?
Would you like
Hi.
to learn about the EIP?
Yeah, investing 101.
Sorry, Paul.
You're fine.
Okay, I will.
If you want to,
I've made, just put him in a room.
I was gonna say,
We have chairs out there.
We're, yeah, we can,
Oh, he's, okay. There's a,
I was just waiting here.
yeah. What-
Sorry.
That's okay.
We're right in the
Welcome
middle
to
of
practice.
a
I'm
lunch
listening
and
fine.
learn.
Nice to meet you.
We're just having a lunch meeting, but we'll be done in a second.
okay, that's fine.
Okay, thanks, bud.
Let's speed this up. So,
It's okay, we have 15 minutes.
Yeah, we're fine.
He's okay.
I'm sorry, yes, we do.
It's cool.
So, lost my train of thought here a little bit. Okay, so mutual funds basically pull all this money together and go out and buy hundreds, if not thousands, of stocks. That way, if Enron had been in that portfolio or that mutual fund, it may have only represented like 0.01%. So, if they went out of business, so what? It really didn't. In fact, you probably wouldn't even have noticed it in your account. So, we're just trying to dilute your risk. And even though maybe your account did do really, really well over the last couple of years, that's just because it's like a rising tide floats all boat. You know, you put a bunch of toys in the bathtub and you start filling the bathtub up, everything's going up. We've been through that for the last 10 years.
So should we be expecting a drop soon?
Yeah.
I don't personally. There's all these little things or gauges that I'm looking at to define like what would trigger a recession. And they say bull markets, which is what we've been flying up in, don't die of old age. They always die of some catalyst. And the catalyst is usually driven by a major market event like Enron going out of business,
Right.
or tech bubble bursting, or financial markets going in haywire. It's most often driven by the Fed. And the Fed is extremely slow to increase rates. If they just suddenly came in and say, we're going to go from around 3-4% up to 7%, yeah, we'd have a problem.
So people are very excited because Janet Yellen is stepping down and she's being replaced by Powell, who is not eager to start QE3,
QE3.
which was the purchase of treasuries and mortgage-backed securities. And basically it floats the economy. Because it's like saying, nothing's going to fail, we're going to put more money in. And the new guy who's coming in, he bought into that too. I mean, he signed off. They say in the notes that are released, they release notes every 5 years. And about 5 years ago, or 3 to 5 years ago, it looked like we could kind of slide back into a recession in like anywhere between 2011 and 2013. And he was like, well, I just don't know if all this buying of all these treasuries and securities is a good idea. Long story short, he's on record now because they release those notes every 5 or 6 years. They release the detailed notes, and they released those notes last month or within the last 30 days. And they basically have him on record saying he wasn't sure we should be buying all these securities. But that was at a time when it was very unclear whether that would work or not.
Exactly. It's all theory.
And it worked. And so, you know, now that everyone knows that worked, it doesn't necessarily mean he's a hawk that is going to bring the bathtub down and lower all the water either. Because he experienced that and was there for that to happen. So he's part of it. And so, you know, they always keep the same people running the ship. You know, Janet Yellen does not run it by herself. So even though she's stepping down, and they promised to raise interest rates 3 times this next year, which will lower the market. It will cool the market off some. But the interest rate increases we've been seeing are 0.25% per raise. So
Which
that
is
means,
normal.
Well, it's nominal. It's very small.
Right.
So that by the end of a year, you might only see an increase of 0.75% increase in the interest rate, in which case you're only going to see things cool off a little bit. The only alternative to that would be if they raise rates by 2 or 3%, and then you're going to watch the housing market get harder to sell houses. And that may happen separately for different reasons, because the housing market is in the middle of a housing challenge, a change in housing. because what's happening is they're trying to change how people write for large mortgages over $750,000. But the people who have over $750,000 or who are looking at houses over $750,000 are less affected by those changes to those policies in general.
Different
Yep.
tax bracket.
And everything's a balance, so if interest rates go up and it's kind of a negative impact on the economy, well, tax reform is kind of balancing that out. 'Cause these
Okay.
major corporations are really gonna benefit from this. Not all of them, you know, some of the tech firms, they already have a super low tax bracket, but
No.
energy firms, manufacturers, all that, very high tax rates. We can kind of balance those two out.
But
It's
there
like a
are
win-win for
there are
everybody.
U.S. companies right now that have trillions of dollars overseas
Yeah.
in places like Grand Cayman, Switzerland,
Ireland.
Ireland. And so what's happened is a lot of that money wants to come back into our local economy. That money's eager to get back here and start building new businesses here.
Yep.
But it's stuck in places in Europe and the Caribbean. As that money gets repatriated, which is the natural result of lowering, at least temporarily lowering the corporate tax rate, that money will get repatriated to the United States at that lower interest rate, and you'll see that get reinvested here. So
Which is yay, that's a good thing.
that's good.
Can I pick how much I want to defer at any time during the year?
Yeah,
Technically, it's once per quarter on the quarter.
Is that just the way your company does it?
No, that's just the way the plan document's drafted. That can always be changed. Putting that out there.
So once per quarter.
Mhm.
Okay. Let's say I assume that my tax bracket's not going to drop when I retire because I plan on retiring before my husband.
Yeah.
Is there any options of protecting how much then, what I'm going to be paying?
Yes, there's a couple of things. So one is do what you're doing, defer, get that tax break, but just don't pull the funds out for some time until your tax
Well, I
bracket does
understand
go
that,
down.
but let's say
yeah.
I want to retire at 55 and my
Uh-huh.
husband's not going to retire until 70 because based on his profession is what I need. Like,
Yeah.
I'm not pulling it out, but I
Yeah.
just meant when I do pull it out, if I'm still sitting at a high tax bracket,
That's where Roth comes into play.
right,
So-
can I switch it to a Roth at any
Yes.
time? Okay.
And what's really great about that is that let's say you have been making contributions in that pre-tax kind of bucket, you can always switch to Roth. And Roth is I pay the taxes,
Yeah.
but I never get taxed again.
Right.
Really, really great feature when used properly, which
Right.
that would be a great example of why to do that.
Yeah.
And yeah, definitely.
Yeah, I get part of it.
If you're a really diligent saver or have a fact pattern just like that or both put together, fantastic. Roth would be great.
What does your company do for us as far as do you help us, can you come once a year and, talk about what our plan's been doing for the past year and if we need to switch to more stocks or bonds or?
We can do that anytime. So
Okay.
although it has been several years since we've been out here last, we're always at least a phone call away. At worst case, call. We can have either over the phone discussions, email. I can come here and do this more regularly. We are pretty flexible, and we're not right up the road, but
Okay.
figuratively speaking, we're pretty
Local.
close. It took me
Okay.
15 minutes to get in there.
Great.
Yeah, we're wealth managers. So a lot of people have a lot of money and they're trying to find the best way to maximize that.
Yeah.
So when I worked in Dallas for a little while and I worked with guys that made $200 million a year. And so we're like pulling the tax code off, trying to find any little thing that we could do to help them minimize tax. I know that nobody in this room, I'm thinking, is in that kind of income level, but it doesn't mean that several of those rules can't be applied to you. And I much prefer dealing with you guys than those guys because it's a different world.
Yeah.
Which I mean is a compliment, please take it that way. And you too. And the phone.
Or he will, yeah. If she wants to get signed up for the 401k and everything, you got the paperwork for her and stuff. Perfect.
I do.
There you go.
Yeah.
It's my first time.
This is her first time. She's very excited.
Yeah, this is a big deal getting involved in these, and I be really frank here. I'm super irritated that the IRS calls these 401k plans. It's an IRS code section. So call it an employer savings account. I mean, that's what it
It
is.
sounds so much better.
Yeah.
Savings.
A savings account. That's all it is. A savings account.
I love to save.
Yeah, that's all it is. Savings account. But nevertheless, when you go to work for a company, you say, "Do you have a 401k plan?" Okay. Just say, do you have a savings account that I can partake in? That's all it is. Yeah, and Terry, would you want to be the I was gonna say the gatekeeper, but the person that pushes the paper back and forth? And money goes in, another important part. The money that goes in there is your money. If you're not around to collect those funds, i.e. you get hit by somebody walking out to your car, let us know who you want to have. It's one of the forms in here is a designation of beneficiary form. If you're married, it's got to be your spouse. If you're not, be anybody you want. There's a couple of different ways that you can go about filling it out. There's a primary, contingent, and so on. But don't ever be afraid of filling out a brand new one of those. They always can be superseded by whatever you fill out next. Yeah, this is a big deal. I'm excited about it.
It's exciting. This is your future.
An analogy that I can throw out there, I know we're making her blush. It's a snowball rolling down a mountain. The longer I have that ball can keep rolling and rolling and rolling, it gains more and more momentum, and from the cartoon days, the ball gets bigger and bigger. If I drop it from halfway down the mountain, it doesn't get nearly as big. We're just trying to get everybody to start as quickly as you can and let some of that time build into your favor.
We'll be right with you.
Okay. Thank you for being here.
Okay, what are the questions? 'Cause I know I'm
Good.
gonna start pushing buttons here.
So I guess just since they brought it up, could you just briefly describe the Roth so she knows what that is?
Yes. So that example I gave where you're in a 25% bracket and odds are I'm going to retire in a lower bracket, well, the IRS says the difference between the break I got today, the savings I got, and the amount that I actually do have to pay back, that difference I get to keep. That's my money. What if you're in the exact opposite situation? What if you're in a low tax bracket today, like 10%, 15%, whatever, super low, and you probably think I'm going to at least be in that, if not much higher when I retire? Wouldn't it be great if I can pay the tax at this lower rate and no matter what it grows to, I don't care, I don't pay any tax on that. That's what Roth does. So literally when you're looking at this page, there's section 1, which is your personal information, and then right below that, step 2, it says what percentage or what dollar amount do you want coming out of your paycheck, and you can pick between, and do I want it as pre-tax or do I want it as Roth, the drop right below it. And that is a more challenging type way to think about it, but there's so many different scenarios that we could go through. If you want to call me and we'll talk about, maybe in your situation, if you
Pretty much it means you want to pay taxes today or taxes when you retire.
Taxes
Really
now or
fun.
taxes in 30 years.
Yeah.
So if you think the government is going to need more of your money in 30 years than they need today, then you might think about a Roth. If you feel like maybe the government's spending more money than they have, and that the likelihood is in 30 years they're going to need a lot more money and they're going to start taxing wherever the dollars are, then you might choose a Roth.
And you can
But
always change
there's
it.
no guarantee that the rules don't change someday and that the world doesn't change underneath your feet too. And so if you get a tax break now, that's not so bad either, because then you know what you're getting. In 30 years, there's an expectation that you'll still have the Roth and that they won't have modified it in some way to take away that useful, meaningful part. But it's not the easiest decision. And so I started my first probably 7 years, I deferred only to the Roth part because I figured that money has the longest time to grow and the most likelihood that it'll be taxed at a higher bracket when I get old and die, because I'll hopefully have so much going on that I will be generating so much income that I'll be at a higher tax bracket no matter what. And so for me, I think a Roth makes more sense. But right now, I switched to doing half of it in the Roth and half of it in traditional, because then I know I'm getting something now, and right now I have young kids that are expensive. And so taking some of that break now isn't so bad either. And so but once I have no kids in the house, if I'm still contributing or still in the same plan, I might switch back to Roth again, because it still might make more sense, because some of the money that's going in there, the match part of the money that's going in, that money's going in traditional anyway. So that money's going to get taxed at the other end. So the match part is always going to be traditional. The Roth would just be whether you're contributing in a way that it gets taxed on the other end or not. Roth money will not get taxed on the other end. Traditional money will, but if you're going to be in a lower tax bracket when you're retired, he's right. If you're not going to take, if when you retire, you're not actually working another job. See, if you retire and then start working another job, let's say you retired at 70 years old, and then you took another job, and that job paid you $10 million a year, then whatever money, and then this illustration doesn't matter, because you're making $10 million a year, who cares?
And God bless you.
Yeah. Well done.
Right, you've won life.
Money anyway. Good. Okay.
Is that your number?
Yes, and I did it for the video's prosperity purpose, so
Okay.
she can
Yeah.
look at it later.
Thank you so much.
Yeah,
Thanks for
it's
being
my
here.
pleasure.
I know it's good for us to get an update.
Sorry, now that you've already taken pictures and EIP dot, let's see, you want that as well? In the old school way, I can give you a card too. That's
Yeah,
helpful.
let me get the card and
Yeah,
I'll,
I'll get the card too. It makes it much easier.
and I'll staple it to the form.
So,
Okay.
Thank you.
um,